want an exposure to a market or an
Everything they need in one place.
Being the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar TV. I'm Emma Wall and joining me today is Job Curtis, manager of the City of London Investment Trust. Hello, Job.
Hello, good morning.
So what are your three stock tips?
Well, at the larger cap end of the market, where I see most value at the moment, and the three stock recommendations or tips are HSBC, BP and Marks and Spencer's.
So why have you chosen these?
Well, I think they're both stocks with, all three stocks have got reasonable dividend yields. Perhaps we'll start with HSBC, which is largest bank in the UK stock market, traditionally very conservative. It's got a lot of virtues, very strong capital ratios, and a very good geographical spread. Some 50% is in the Pacific and emerging markets. Over the last year, they've really cut out some of their smaller territories, and they're focusing more on their more profitable territories where they've got stronger market share. They're benefiting from recovery in the US operations, which was so disastrous a few years ago. And I think with a dividend yield of around 4.8% and very strong dividend growth in prospect and a price to book ratio of about 1.2 times, it does seem quite modestly rated within context of stock market where so many shares have performed exceptionally well. This one looks sort of very solid value, especially for the income seeker.
And BP?
BP's, in some respects, slightly more controversial. It's now slightly over 3 years since the Macondo spill in the Gulf of Mexico, and they're obviously still embroiled in the US in legal disputes. And I think initially they were somewhat naive with the US lawyers, and they're now taking a stronger line, and that does overshadow the stock a bit. And I think that's as a result, it's actually on a very cheap valuation. It's yielding over 5% and a PE of around 8 times. And actually, as a result of the Gulf of Mexico spill, they've done a number of things. They've sold off some elements of their portfolio and ended up with a somewhat higher quality portfolio. And in addition, they've done a good deal in Russia where they had a successful joint venture operation at least, but they fell into dispute with the Russian owners of it, and they've sold out to Rosneft, and they now have a 20% stake in Rosneft, which is the major Russian oil company, which looks like a good investment to me. So all in all, both Shell and BP have lagged the market over the last year, and they certainly sort of underperformed a rising oil price just in the last month or so. So they look really quite good value to me, and I think this one's more of a slow burn. I think that it's on a significant discount to some of the parts, of some 25-30%, and I don't think that discount will be realised until the US legal situation is sorted, which it will in time. So it's more a 2 to 3 year view perhaps on BP, but in the meantime, you're paid while you wait with a 5% dividend yield.
And so HSBC and BP making global efficiencies there. What about your third?
Well, Marks and Spencer's is obviously much more a UK story. They're actually, in terms of the sort of future growth, part of the growth will come from moving a bit overseas with mainly franchised operations going back into Paris, and that should help grow sales and profits. In addition, they're expanding more aggressively into the internet, and they've lagged online. But I think what's particularly interesting about Marks and Spencer's is that they've investing very heavily in CapEx in some of their processes, improving their distribution. That CapEx program is ending, over the next year or so. And I think on brokers' forecasts, it's estimated it's going to free up something like £250 million of surplus cash flow. So you could end up seeing Marks and Spencer's. The yield's about 3.7%, so it's slightly lower than the other two, but you could see quite a virtuous circle with share buybacks in a way that Next has done so successfully and helped its stock price. And if you look at the underlying core business, the food business is a strong one and grows its like-for-likes and is a quality operation. The problems have certainly been in general merchandising, but I think with the slightly better outlook for the UK consumer, with house prices improving and interest rates forward guidance staying low, I think this could be quite an interesting. It's a mixture of a recovery play as well as having some top-down factors benefiting it as well.
Job, thank you very much.
Pleasure.
This is Emma Wall for Morningstar TV. Thank you for watching.